In 2021, the hedge fund industry controlled over $1.3 trillion of capital, with the top 15 hedge fund managers taking home over $1 billion apiece. But just how do these hedge funds make such huge returns? Hi guys, Joe here from Money Talks, and today we're breaking down the top hedge fund strategies. There are three main categories of investment strategy used by hedge funds to deliver these returns: equity strategies, macro strategies, and arbitrage strategies. Let's start off with equity strategies, and as the name suggests, these revolve around investing in stocks. One of the most common equity strategies is known as equity long-short. The goal of these funds is simple: buy winning stocks and short losing stocks. They often aim to be market neutral by going long an equal amount to going short. This means they are only exposed to the desired variables and are hedged in the overall market. Alternatively, they may have a net long position, which introduces an element of market timing to their overall return. Let's take an example. Suppose Coca-Cola is marketing the release of a new drink. A hedge fund analyst might decide that this new drink will take away market share from Coca-Cola's competitor, Pepsi. In this case, they would buy shares in Coca-Cola and short shares in Pepsi. If the analyst's prediction is correct, and the price of Coca-Cola shares rises while the price of Pepsi shares falls, the fund will profit directly from this change in market share. Melvin Capital, which famously lost around $7 billion betting against GameStop in early 2021, is an example of an equity long-short fund. On the other side of the coin are short bias funds. As the name suggests, these are funds that specialise in finding losing stocks to short. They use methods such as forensic accounting to identify fraud or overhyped stocks. This is an inherently risky strategy since the general trend of the stock market is upward. Stocks only go up, am I right? Jim Chanos of Kinnikos Associates used this method to correctly short Enron prior to the company announcing bankruptcy. And more recently, he correctly shorted Wirecard prior to the stock dropping 96% after fraud was uncovered. Finally, we have quantitative or quant funds. These funds use algorithms and vast amounts of data to identify trends in markets and build predictive trading models. One of the most common trends used is momentum. When stocks go up, they tend to keep going up for a little while, and vice versa. Some of the most consistent performing hedge funds are quant funds, with Jim Simon's Renaissance Technologies leading the pack. Rentech's Medallion Fund has returned over 66% a year before fees over its 30-year lifespan. Compare that to just over 10% for the S&P 500 over the same period. And unfortunately, no, these returns are not available to you or I. The Medallion Fund is closed to outside investors. Next, let's take a look at macro strategies. These strategies are primarily concerned with forming opinions on the overall economic or political landscape of a country, and can be multi-asset, covering equities, bonds, currencies, commodities, and futures. Often, these funds make large directional bets on a certain outcome and make a lot of money if they're right, but lose a lot of money if they're wrong. Similar to equity strategies, these can be discretionary or systematic. Discretionary macro strategies are referred to as global macro, whereas systematic funds employ managed futures strategies. The key difference is that global macro strategies are forward-looking, which means that analysts look at fundamentals and make a prediction about the outcome of a situation. On the other hand, managed future strategies are backward-looking. Algorithms will look at past price data and construct strict rules around when to trade. Anyone who's seen The Big Short will know about Michael Burry and other investors who famously anticipated the subprime mortgage crisis and bet against the US housing market.
You want to bet against the housing market?
Yes. Why? Those bonds only fail if millions of Americans don't pay their mortgages. That's never happened in history.
John Paulson of Paulson & Co. made what is often referred to as the greatest trade of all time by making $20 billion betting against subprime mortgages. This is a great example of a global macro strategy. The final group of strategies that we're going to look at are arbitrage strategies. Broadly speaking, arbitrage is when an investor simultaneously buys and sells an asset in order to make a small profit from the price discrepancy. Often, these discrepancies are minuscule, but using leverage can be scaled up to deliver impressive returns. Since a hedge fund's exposure is market neutral, these small profits are often assumed to be risk-free. We will see later on, however, that this is not always the case. Within this group of strategies, there are several sub-strategies that we will cover: event-driven, convertible arbitrage, and fixed income arbitrage. Event-driven strategies are typically equity-based and revolve around profiting from deviations in price that occur between a corporate event being announced and actually happening. Suppose Meta, the company that owns Facebook, announces it is going to buy Snap for $50 a share, $9 more than the share price today of $41. The price of Snap will instantly jump since investors are anticipating selling their shares for $50 at some point in the future. However, the share price will most likely not reach the $50 per share buyout price, as investors know there is a chance the acquisition will not go ahead. Let's assume the share price rises to $48. A hedge fund can analyse the chance of the acquisition going ahead, and if they believe it to be profitable, can buy Snap stock and potentially make a $2 spread per share. Other event-driven strategies can centre around IPOs, when a company lists on a stock exchange, carve-outs, when a company sells a part of their business, or any other corporate event. Convertible arbitrage involves taking simultaneous long and short positions in a convertible bond and the underlying stock. A convertible bond is a hybrid security which can be converted to the stock of the issuing company. The convertible bond's price is determined by interest rates, the price of the underlying stock, and the issuer's credit rating. And so by hedging two of these factors, a hedge fund can get direct exposure to the third. As liquidity is sometimes an issue for these securities, price discrepancies can arise between the bond and the stock, which allows a hedge fund to make a profit. Finally, we have fixed income arbitrage, where hedge funds aim to profit from price differences between bonds and other interest rate securities. As with most arbitrage strategies, fixed income arbitrage funds tend to be market neutral, meaning they are long and short equal amounts. Due to the size and illiquidity of many fixed income markets, price discrepancies can arise that, when magnified with leverage, can generate significant returns for hedge funds. Long-term Capital Management was a hedge fund that used arbitrage strategies, and in 1995 they generated a return of 43%. As we know, however, these strategies require significant leverage to be profitable. LTCM was 27 times leveraged in 1995, meaning the actual return of their strategy was around 2.5%. As these returns were supposed to be risk-free, leveraging so highly was not a concern. The dangers of such high leverage were made evident, however, when an opportunity the fund was pursuing didn't go as planned, losing them $4.5 billion over several weeks and leading to the fund's collapse. That's a lot of money. That concludes our list of the most popular strategies used by hedge funds across equities, macro, and arbitrage. As we've seen, when it comes to hedge funds, there's a lot of money that can be made from getting it right, but getting it wrong can be lethal. Thank you for watching Money Talks. I hope you found this video interesting. If you have any questions or comments, please leave them in the comment section below and I'll be happy to get back to you. Have a great day.